Hello everybody, this is Eddie Ghabour, CEO and co-founder of Key Advisors Wealth Management. Please follow us on our YouTube channel as well as follow us on Twitter. You can follow me at Common Sense Bull, and we tweet our videos and sometimes some of the moves that we are making within our portfolios, and hopefully they bring value to you and your family. Today I was on Fox Business on Stuart Varney's show this morning, and I talked about the reason why we felt like buy and hold was not going to be a winning strategy for 100% of somebody's portfolio in this market. And we got a lot of emails and questions on that, so our team met and we said, you know what, let's go ahead and try to shoot an educational video and elaborate a little bit more on what we mean by that. And of course, just because it's our opinion doesn't mean it's something that's going to work for you, but this is how we have evolved as a firm in regards to changing the way that we manage client assets over the last few years. In our opinion, post-COVID has really changed this market. It's changed the behavior of this market, and it could be changed forever. We'll have to wait and see. But we are in uncharted territory in some of the things that we're seeing. And to us, a buy and hold strategy where you just have an old school type of account, and I call it old school, where you fill out a questionnaire and then you own a little bit of everything based on your risk tolerance. Stocks to bond ratio, and you own emerging markets, small caps, mid caps, large value, large growth, all different spectrums of the fixed income. And of course, your stock to bond ratio is dependent upon how you answer that questionnaire. And then it's a set it and forget it type of strategy where you hear things like just ride it out, stay diversified, it will come back. Well, one of the things that we try to do is educate ourselves on what investors are truly looking for. And one of the things that we have gotten from the feedback from the calls that we've gotten is people are tired of hearing that same old song and dance because it just hasn't really worked over the last 3 years. And the best example I can give you is you take a look at what a 60-40 portfolio has done, and it's still anywhere between we've seen 10 to 13% off of its all-time highs, even though the S&P's hit an all-time high. And that's because when you dive into that there are a lot of assets within that portfolio that are just in bear markets that just haven't performed for the last few years. You look at long-term treasuries, it's been unprecedented, but they're down about 37% from the end of 2021. Small caps approximately down 20%. China has gotten beat up, and that's a big weighting in some emerging market funds. You look at a fund like ARK Innovation that is a high-risk ETF, but a lot of investors owned it. It's still down about 60% from the end of 2021. And you look at names like Tesla, they're down 40%. So this market has been very concentrated in certain areas that have had momentum, and we believe that that's where you need to be. You don't need to just have this broad brush approach because, again, if half the portfolios in a bear market are not going to perform, what's the reasoning behind taking that much risk from a risk-adjusted standpoint? So over the last 3 years, we've been a lot more tactical in our approach and a lot more concentrated, where maybe being too diversified just isn't going to work. So we've increased our percentages in certain momentum areas, and we've also not been afraid to sell quickly when we're wrong or even quickly when we're right. And the best example I can give you is a trade that we just recently made. We bought an ETF that tracks long-term treasuries, and it was a play on interest rates. And when you're buying a bond, it depends on what type of bond, but for us, if you get a 6 to 8% return in a bond, that's a pretty darn good return from an appreciation standpoint, considering the risk you're taking. Well, this thing moved by 3% in less than 2 weeks, right before the Fed was going to speak. And we thought to ourselves, look, if this Fed comes out pretty hawkish, this could completely reverse and be down 4 or 5%. And we're talking about a bond. So we went ahead and quickly traded it. And normally you wouldn't trade a bond after owning it for 2 weeks, but it just goes to show how much things have changed and how quick things are moving. Even in how fast we get information, right? You can stay on Twitter for 24 hours and you're going to get a million different opinions, and some people will act on those opinions. We've seen tweets that move markets. We've seen tweets that don't do anything to markets. And so we're in this never-ending 24-hour media that continues to give us information, some good and some bad, And then the options market. I never thought I'd have to worry about zero-dated options, but we've had days where zero-dated options have accounted for a majority of the volume. And if you don't know these things and you don't know where the money flow is going, it puts you at a big disadvantage. So in our opinion, the game has changed, and it's changed in a big way. And you either have to evolve or you're going to die, because the old approach of investing may not work for the next decade. And again, I want to stress, for us, buy and hold for some part of a portfolio is absolutely fine, but by no means for our client base would we put this portfolio together and say, just ride it out, it will come back. The biggest value to me that a tactical and active strategy does for an investor, if it's done correctly, is hopefully, if they're good at what they do, it will protect against major drawdowns. It's simple math, especially if you're retired or approaching retirement. If you never lose 20 or 30% of your portfolio, then your up years don't need to be that high. And that's what people a lot of times forget. So, riding it out means if you take a 30% hit, you need a 42% return approximately to get back to even. That could take years. And if you're approaching retirement with that type of mindset, that could change your retirement date or change your lifestyle. So for us, we look at ourselves as risk managers. We want to always be nimble enough that if something gives us a major warning, like at the end of 2021 does, that we can quickly make changes to an allocation to protect our clients' hard-earned capital. And that, to me, is one of the biggest values that having an actively managed strategy can do, as long as you have the right team and process behind you. So at minimum, if someone has a passive strategy they're not going to do anything with, at least by having a percentage in something that's tactical and active, you can protect a big percentage of your overall portfolio. Again, you have to be right when you do that. But again, being able to protect against major drawdowns is extremely important. And I just want to kind of end it with this. And for the same reason why perma bears aren't going to be right all the time and perma bulls aren't going to be right all the time. You have to be open and objective to things and be able to be bearish when it calls to be bearish and bullish when it calls to be bullish. In our opinion, anyone that thinks that sometime over the next few years, when this debt has to start getting refinanced, that there's not going to be potentially some downdrafts that you're going to need to protect against, I think they're going to be very naive in thinking that. We have now again shifted to being more bullish here going into November, because we believe the government's going to do everything they can to keep things stable. So we plan to keep buying in the first quarter of this year and get as close to fully invested as we feel comfortable, as long as the data that we're watching stays the same. And we're doing that because we expect the things that we're going to be buying over the next several weeks, as we started in January, will hopefully give us some really nice returns. But all bets are off as we get closer to the election and post-election, because in our opinion, you can't borrow money at this pace. We are in an indestructible path when you look at consumer balance sheets, when you look at company balance sheets, and goodness, this government balance sheet. And when these debt starts rolling off, what's the incentive post-election to keep things up the way that they are from a fiscal policy perspective? So there's lots of risks out there. So even though we've gotten bullish here near term, does not mean that we have things on a short leash and will be willing and able to get out if and when we need it to. And so again, that's the biggest value of not having just a buy and hold for 100% of your portfolio, because we are not okay with losing a big percentage of assets. We're not going to say just ride it out. We're going to do everything in our power based on the resources that we have and the knowledge of our 25 years of doing this has to try to protect and grow our clients' capital in that order. So I wanted to, again, spend some time to elaborate on today's interview, and hopefully you got value out of today's video that we will put out for everyone to elaborate on the things that I talked about with Stuart Varney today on Fox Business. Thank you, and thank you for watching.